let me set the stage for today's episode. This isn't a surface level conversation. We're getting into real world insights, what actually works, what doesn't, and how to apply what you hear today in a practical way, whether you're building a business, a brand, or your next opportunity. And I want you to stay with me until the very end, because I'm offering a free bonus specifically for listeners who finish the episode. Something that can help you skip the line and move faster if being on this show is something you've been thinking about. All right, let's get into today's conversation. Welcome to the podcast today. I'm happy to introduce today's sponsor, Laxman, co-founder of DocWealth, for physicians who want to accelerate financial independence with strategic tax planning. Laxman and his co-founder have a very fascinating backstory, how they founded DocWealth. I'm really happy to have him on to share more. Laxman, welcome.
Thank you, Chris. Happy to be here.
Briefly introduce yourself and we'll dive into the questions.
I'm Laxman, co-founder of DocWealth, from Florida originally, but my background's a CPA, been in accounting for a while, then worked in Silicon Valley for about 10 years in tech companies.
You've been featured on platforms such as White Coat Investor, Physician on Fire, trying to spread out the news. What led you to co-found DocWealth?
My college roommate is a physician. He's a 1099 locums emergency medicine physician. A couple of years ago, he called me and said, "Hey, I'm trying to find a CPA or someone to help me lower my taxable income. I'm not able to find someone that specializes with physicians, doctors, or medical professionals. I'm getting different strategies. I need more handholding because I never taken any finance courses in residency." I didn't know any on the top of my head. We got on a bunch of calls and spoken to different companies. Nothing felt right. We felt like, okay, there's a large gap in the market. If no one is serving medical professionals and physicians, maybe we should create it. We're both pretty entrepreneurial. I worked in tech, surrounded by startups. My co-founder, Mark, he has a PhD in engineering and became a physician. We decided to build something catered to this niche that solved a need. That started 2.5 years ago. Now we work with over 1,000 physicians, grown pretty rapidly.
Amazing story. Who do you serve?
We work, I would say 90% are physicians who have 1099 business income or in real estate. The other 10% typically own their own practices or pure W-2. Everyone has the same problem. How can I minimize my tax liability in a legitimate, compliant way? There's a lot of social media that says you can buy insurance policies, do conservation easement. The profile we work with is compliant within the tax code, but maximize and leverage the tax code to its full ability. That's what we do. We create a one-stop shop, bring in tax attorneys fully versed in tax compliance strategies, then a bunch of CPAs and enrolled agents who work on the tax strategy side between real estate and every tax strategy that you've probably heard of. Have a sense of background. We have a team of over 25 experts in every field, from entity formation, payroll, bookkeeping.
What strategies are most commonly used by your clients to mitigate taxable income?
That's a great question. It's 2 buckets, W-2 or business income. 1099, you own your own practice. Real estate, W-2 is limited. The tax code heavily favors those that are owners have business income. W-2, it's more along the lines of having to invest in certain asset classes. You can depreciate, accelerate depreciation, or defer it. The basic concept is money is more valuable today than it is later because we have inflation. $1 today, 10 years from now, could be the equivalent of $2 at that point. The most common in W-2 is real estate. That could be the short-term rental loophole. Buying a short-term rental property, an Airbnb or VRBO, then you're able to do cost segregation study, which accelerates the depreciation of the property. Not to get too in the details, but you're taking the property's value, say it's $500,000, you can probably do 25% in the first year. So that's a $500,000 property. It's $125,000 deducting against your W-2 income. In year one, based on your tax rate, that could be $30,000, $40,000, $50,000 in cash that you can deploy. Then I would say there's other investments like oil and gas, opportunity zones. 1099 business, the world is your oyster because everything very necessary becomes expensible.
I know a lot of doctors, spouses, there's the real estate professional, they buy rental property, get the spouse to qualify for rep status, and it decreases their taxable income. How legit is that strategy?
There are definitely compliance rules that you need to follow. Uncle Sam is not just going to let you keep your money. You got to make sure you check every one of those boxes. And that is a great strategy. It's legitimate, but you have to follow the rules. Long-term and short-term rental have different rules. The more difficult one is doing the long-term rental. To get rep status, you have to show 750 hours in the year that's documented towards that real estate activity. You're basically saying that your dominant job is real estate. That's how you qualify. This can be pretty difficult. This is a very common strategy, especially if your spouse is part-time or stay at home. It's doable, but you have to be able to log the hours. If you're able to do that, you can do what I mentioned before with the accelerated depreciation.
How much in tax savings, success stories? What separates DocWealth from other tax professional advice?
DocWealth is unique in the sense that we built this company from the client physician perspective. Most times when I'm talking to companies, they were all doing the same thing. As a generalist, you can't be proficient if you don't niche. Now, we spoke to over 1,000 1099 medical professionals, real estate investors in the medical space, and said, hey, what are you missing with your current tax professional? There was 3 pain points. We built the entire company around those 3 pain points. One was, I can't get a hold of my CPA. It takes weeks. I never hear from them. Over 92% said that. We ensure a 48-hour response rate, which no one commits to, but we have it within the entire team and consistently providing that. The other thing is that we wanted something education focused. Teach a person to fish, feeds them for life. That is a big philosophy here at DocWealth. We are constantly adding to our education platform as we work with 1,000+ clients and doctors. When we see success stories, different strategies, we're always including that within our education platform. Everything is very simple and accessible. Everything you can understand within 5 to 7 minutes max. We didn't want to have this huge, long video that would take 20, 30 minutes and no one ever go through. That was the second perspective. The third is having a proactive, hands-on approach. You can reach out to us anytime throughout the year. There's no nickel and diming. We have a flat fee structure. It's a subscription model. You can use all facets related to tax and accounting. That's what's made us unique. Only been around for 2.5 years, working with over 1,000 clients. Very fast adoption. Probably 70% has been referrals, which is the most important metric.
Quick pause here, because if this conversation is resonating with you, you'll want to stay until the very end. At the end of this episode, I'm giving listeners who finish priority access and the ability to skip the line if being a guest on this show is something you've been considering right now. No action needed. I'll share exactly how it works at the end of the episode. All right, let's get back to the conversation. As you mentioned earlier, you are focused on 1099 and physicians earning business income, practice owners, 1099 physicians, locums, anesthesia. Should they do S-Corp?
I get that question a lot. I've spoken to our tax attorneys about this. If anyone quotes you an exact number of 70,000 or 100,000, there's no right number. It depends on your situation. You have kids, or are you married? What is your total household income? S-Corp can be powerful. It acts as a bell curve. After a certain income limit, it starts to yield many benefits. If you start making too much, it starts to phase out. An S-Corp at its core splits your income. Say you're making $500,000 into a W-2 and then a distribution. The distribution does not have to pay payroll taxes or FICA. So effectively, this is 8-9% on that amount of income. It starts to add up quickly. With an S-Corp, there are compliance items that's more complex than an LLC. An LLC is a disregarded entity. All the income is going to flow down to your name. There's no real difference. It's more of protecting against liability. If someone comes to sue you, they can't go after your personal assets. With an S-Corp, you have to have a payroll management system. You have to make sure the reasonable compensation W-2 is not too low. Not paying payroll and FICA adds up to be quite significant. It's all a math equation. If I'm able to save more money with the additional headache of the S-Corp, which my accountant's going to already take care of, it's going to be well worth it. The vast majority are using an S-Corp, especially with us.
A follow-up question on 1099. You wrote a post about tax mistakes 1099 physicians must avoid. What are people doing incorrectly?
Some of the mistakes that I see quite common is it's important to separate personal and business expenses. Using the same credit card for personal and business, and they think I can just show my bank statement. That's incorrect, because for the classic example I use is if you go to Costco and you swipe for $250, who knows if it's a laptop for work or if it's groceries. And so that doesn't qualify as a deduction or expense. So it's important to keep a good structure of business within the business credit card and making sure it's all legitimate business expenses. And that can be anything that's ordinary and necessary to generate income. The second one is around the home office. If you have a space in your home that is enclosed and you say is dedicated towards doing work, then that's something that where you can start writing off the mortgage, interest, utilities, all the expenses related to that. It's very important. This is one of the highest audited items that you don't start claiming your living room, kitchen, and stuff. It's got to be defendable. The last one is looking at, does it make sense to have an S-Corp or not? Many people think, I'm going to get paid to my name and maximize things. Tax code is thousands of pages. Each state has its own rules, PTET, SALT deduction, the big beautiful bill. Getting a consult understanding, hey, for my state, what can I do and how do I navigate it? Knowledge is power and money.
Well, we talked about the big beautiful bill as well as year-end tax planning moves. For people listening, maybe final year of residency, they're getting job offers. Should they take the W-2 versus 1099 for their first attending job?
Great question. We worked with 200 new graduates this past year who became attendings. That is probably the most common question. If everything is equal, 1099 income, you're going to be able to save a lot more because of how you can structure it right off. It becomes a math equation if the 1099 is less. But the 1099 locums will allow you to contribute so much more to retirement accounts. With the solo 401k, you can do up to 70,000 versus 23,500 for 2025 limits for 401k. You're able to do the home office. Maybe you're finally starting to buy a car. You can expense, if it's over 6,000 pounds, it's up to 100% of the entire car with the big beautiful bill. If it's over 6,000 pounds, buying an SUV, $100,000 car, the percentage of what is business, almost 100%, the 100,000 is deductible against your income. You can't do any of that with a W-2. It's about knowing your structure, what you can do, how you execute it. When the filing comes, you have to know how to file. TurboTax is great for W-2, but not well equipped for strategies that you're doing.
As you mentioned the car with the big beautiful bill, what other aspects of the big beautiful bill benefit physicians, W-2 or 1099?
Yeah, I would say the 100% bonus depreciation with real estate is big. We saw many real estate purchases in the second half of 2025 because you have 100% bonus depreciation and it 40% previously. So that was one of the biggest ones. The other major one, I would say the big beautiful bill helps those making it in that income range of 200 to 600,000 because of the increase in the SALT limit from 10K to 40K. I'll keep it high level of what this means. If you live in a state that has high property tax, state taxes, this is huge because previous limit was you can only deduct up to 10,000. Now it's up to 40,000. That's a $30,000 increase. It starts to phase out after $500,000 in gross AGI. If you're married filing jointly, that starts to go down. That's why I say that 200 to 600, you start to benefit from that because you can offset your federal income tax using the SALT. Those two are the really big ones that I've seen get implemented a lot recently going into 2026.
When you say SALT, people aren't familiar with that term. What is that?
That's the state tax, including the property tax. It's accumulating all those together.
For those doctors that haven't been planning tax, what are some quick, efficient, simple tax moves to lower their tax bill?
I always say tax planning and write-offs, you want to have everything clear in the tax year. Tax filing will happen April 15th or afterwards. It's too late to do the vast majority of write-offs at that point because everything has to be documented in the tax year you want to deduct it. If you have equipment, scrubs, CME, travel, make sure it's an expense. You have the receipts. Solo 401ks have to be set up this year. You cannot wait till January 1st. It won't be set up in time and you can't contribute. I've seen that mistake many times. The goal is to start as early as possible. We've already started 2026 planning for our physicians. Now, what structures? What should you do? What do you want to get? Solo 401k, any expenses, make sure you have the receipts, organize those key things to do in these last couple of weeks.
The audience, their tax accountant prepares it. What you're offering is strategic. For example, invest in this because of the big, beautiful bill that'll cut your tax bill. For those coming out of residency or those still in their early stages, what is your advice for tax advisor, those that fill a form or actually give strategic advice? How does DocWealth fit that need?
It comes down to two words: reactive or proactive. Reactive is what we've seen is like many tax firms are just collecting documents, inputting into forms. Honestly, TurboTax and AI will do that for you. Tax planning is proactive, looking at your situation. What do you have going on? This is where you are able to create savings. These savings will yield a tremendous amount of cash savings that will compound every year. Many physicians are going to be entering it into the highest tax brackets, and many with state taxes. Even if you're able to deduct $10,000 in a year, a pretty low bar, that's $3,700 back in your pocket. You compound that for the rest of your career until you retire, that's going to be hundreds of thousands, if not millions. We're able to look at situations, optimize, and many times get 30 to 100,000. It pays. That's where you get to, okay, this is well worth it because I'm getting an ROI. I'm getting a strong return on investment that's going to create savings for me.
We have a question from the audience. You help high income earners, early career. What about older practicing generated significant wealth, net worth, tens of millions? What point should physicians start thinking about trusts, partnerships, legacy planning vehicles?
Creating a trust earlier is better. As you're accumulating assets, it's easier to have all those assets be part of the trust from the beginning. I've worked with many older physicians, including my own parents, who created a trust 5-10 years ago. What's the hurdle of organizing and getting everything in the trust? A trust, if anyone doesn't know, protects your assets and ensures that whoever you want to pass it down to, whether it's your kids or family, bypasses probate court, which can be extremely expensive, tax liabilities. A trust, you pay that one-time cost to the lawyer to set it up, but it's a very good structure in protecting all your assets, especially as you're building wealth, buying real estate, or any other investments. I recommend doing it as early as you can.
How can people connect, learn more?
You can find more information about us on our website at docwealth.io. Look forward to working and preserving everyone's wealth.
I enjoyed this conversation and love the work that you're doing. Keep up the great work.
Thank you. I appreciate your time too, Chris. Take care.
If you stayed until the very end, congratulations. You've earned the freebie. As promised, here it is. Email chris@drchrislewmdphd.com. You'll find it in the show notes and simply put podcast freebie. A member of our team will reach out to you about being a guest on the show. If you found value in today's conversation, please take a moment to rate the show 5 stars and follow us on Apple Podcasts and Spotify. It helps more people discover the conversations we're having here. To be a premium guest on the show, book a spot or join our podcast community. You'll find the links in the show notes below. And if you're looking for more personal guidance, you can book one-on-one coaching call with me. Our books, products, and courses are linked in the show notes. Thanks again for listening, and I'll see you in the next episode.